So, why does Bitcoin crash so spectacularly? I mean, it's the question that's kind of defined it for over a decade now. Today, we're going to break down the one fundamental problem that really explains its wild volatility and why, when it falls, man, it falls hard. Let's get right into it.
You've heard the promise, right? We all have. Bitcoin was pitched as this ultimate inflation hedge. Now, a kind of modern-day digital gold, a safe place to put your money when things get chaotic.
But here's the thing. When high inflation finally showed up for real, Bitcoin didn't act like a safe haven at all. Nope. In fact, it did the exact opposite. It crashed right alongside all the other risky assets. And that moment, well, that was a huge reality check. Okay, so if it's not digital gold, then what exactly is it? Well, the data suggests it behaves a lot more like something called a high-beta liquidity sponge. And yeah, that sounds kind of complex, but that term is the absolute key to understanding how Bitcoin really behaves. So what does that even mean? Think of it like this. When money is cheap and everyone's feeling good about the market, all that extra cash gets sponged up by speculative stuff like Bitcoin. And that's what pushes the price to the moon. But the moment fear takes over and that cash dries up, Bitcoin is one of the first things people sell. They wring out the sponge to get cash back, and that's what causes the price to just completely collapse.
Now, that's the theory, but the history, the actual data, backs this up with some pretty startling consistency. So let's dig into the evidence.
70 to 85%. Just let that sink in for a second. That number is staggering, and not because it's some worst-case one-time thing. No, that's the typical, almost predictable, size of a Bitcoin collapse. And this is the most crucial point. Every single market cycle in Bitcoin's entire history has ended this way. It is a repeating pattern of these massive booms followed by absolutely devastating busts. This isn't some rare event. For Bitcoin, it's just the norm. And just to put that pattern into perspective, look at this. Bitcoin's average crash is right up there with some of the worst market collapses in all of history. We're talking about things like the Great Depression and the dot-com bust. When it comes to pure volatility, it's just in a league of its own. And you can see it right here. This cycle just repeats itself with this incredible regularity. A huge run-up, then a cliff-like drop, year after year. 2013, 2017, 2021. You just can't deny the pattern. Okay, so we've established what happens. Now let's get to the most important question. Why does it happen? And it all comes down to the search for a price floor. I mean, why doesn't the selling just stop at some point? Why does the price fall so much further than other assets do? Well, the answer is that most traditional assets have some kind of fundamental anchor. It's a valuation floor that's based on tangible, real-world value, and that acts like a safety net when everyone is panicking. When the price gets low enough, value investors step in because, hey, the asset becomes objectively cheap. Think about stocks, for example. A company's stock price is ultimately anchored by its ability to make money, to generate profits. If the price falls too far, its dividend yield might get really attractive, or its price-to-earnings ratio signals that it's a bargain. Bitcoin, on the other hand, well, it has no earnings. Its only anchor is belief. It's the exact same story with housing. The value of a house or an apartment building is anchored by the rental income it can bring in. If prices fall, the rental yields go up, and that creates a really clear buying opportunity for investors who are looking for cash flow. But again, with Bitcoin, that value is just tethered to what people are feeling. And what about gold? Bitcoin's supposed digital twin. Even gold has a floor, and it's anchored by real-world physical demand from central banks in the jewelry industry. That provides a tangible baseline of value. Bitcoin's demand, by contrast, comes almost entirely from people who simply believe its price is going to go up. So the contrast here becomes crystal clear, right? Stocks have earnings. Gold has industrial and jewelry demand. Housing has rent. These are all real, tangible anchors. The only thing remotely close to a tangible floor for Bitcoin is its use in black markets. And honestly, that's just a razor-thin slice compared to its massive market value. So that leaves it almost entirely floating on a sea of belief. So let's tie all of this together. What does it actually mean when an asset's only real support is what people believe about it?
It means this: the price stops falling only when the most hardcore believers finally decide, okay, now it's cheap enough, and they start buying again. There's no external, objective yardstick of value to stop the slide. The floor is purely psychological.
And here is the really dangerous paradox in all of this. The more the price falls, the more it damages the very belief that's supposed to be supporting it.
You know, a 50 or 60% drop makes that whole digital gold story a lot harder to sell, and that wakens the case for anyone to jump in and rescue the price. In other words, the crash literally feeds on itself.
And so that leaves us with the ultimate question. For Bitcoin to ever escape this violent boom and bust cycle, it needs to find a real, tangible anchor for its value. Until it does, its floor is always just going to be a matter of faith. And the real question is, will it ever find an anchor beyond just belief?